Hi, everyone. I'm Rick Bensignor. Today is Tuesday, November 9th, and welcome to this week's In the Know Trader show. Well, as we record late morning on Tuesday, we've got an S&P that's down about 20 points. We haven't seen that in a while, certainly for a closing type level. What was the statistic I heard yesterday? It's only had like 3 down days out of the last 18 or 19 or something like that. So obviously we've been ripping to the upside. Interestingly, 10-year rates are back down to the lows that we've seen of this current correction, down at about 1.44%. Oil's up a little bit today. Nasdaq's down off about 0.5% or so, and gold, I think last I looked, was just slightly higher. Bitcoin's up a decent amount, over $800, so it's pressing up against highs. And let's take a look at what we're going to talk about today. So first off, in our trader education portion, we're going to talk about using pair trades. In our market overview this week, we'll take a look at the Dow Jones, the QQQ, which is the NASDAQ 100 tracking ETF, the MDY, which are mid-caps, the S&P MidCap, and IWM, the Russell 2000. And then in the sector analysis, what we're actually going to do is, after we've already talked about pair trades earlier, we will take a look at these major equity indexes as pair trades against each other. So we'll look at the Dow versus the Qs, the Dow versus mid caps, the Dow versus small caps, Qs versus mid, Qs versus small, and then mid cap versus small. And lastly, we'll take a look at growth versus value. And we'll get to that in just a second. Just to go through some house cleaning rules and stuff that we do each week is the weekly ETF Tactical Trader Report comes out almost every week on Thursdays. Occasionally we switch it around, but usually it's a Thursday night. That gives you a new weekly ETF trade idea, along with a deep dive into the macro picture of what's going on. We'll always look at the US 10-year, often gold, the dollar, credit spreads, and always a deep dive into the S&P. And you can sign up for that at intheknowtrader.com. And by the way, we do know there is an issue on the services page. We are working on it. We are rebuilding the entire site, but we know right now you can still go to the sign up page. Somebody was saying we can't find the prices of this. It's on the sign up page. So you'll see the different products we have, as well as what the costs are. We also do a monthly 7-Eleven report that's intent is to beat the S&P. We are successful at doing that. We are up, I think, we're up 1.29% in the first 4 months of this fiscal year for us, and up a total of 4.44% in the first, I think it's 15 months since we started. So we are admirably outperforming the S&P. And there we go in no less than 5 or no more than 7 of the 11 spider sector ETFs to be invested in at any given time in order to beat the S&P, with the goal of not only beating the S&P, but doing so by avoiding the underperformers. And again, you can sign up for that at intheknowtrader.com. Obviously, my email, rick@intheknowtrader, and that is that. Let's go back here. Using pair trades. Some of you know what this is, some of you don't, so I want to explain it to you. A pair trade is essentially going long one instrument and going short a similar instrument, often in the same type of group or sector. It could be something like going long gold and shorting silver against it. It could be like going long Home Depot and shorting Lowe's against it. Similar type names. And what you're really doing when you do a pair trade is there's a few things that get accomplished. One is you're, in theory, reducing risk, because in general, you would expect both to go in the same direction. But what you're trying to do is go long the one that you think has better fundamentals and is going to outperform the other one. So if we use, let's just say, a Home Depot Lowe's type long short pairing, if you chose to go long Home Depot, but you didn't want to have the market risk involved, meaning if your timing was just bad, and let's say, and again, I'm not recommending this, but it's a good example. Let's say you thought the fundamentals and the charts were good on Home Depot, and you want to go long that. But let's say that when you did that, it just so happens to be when the whole market corrected by 5%. Well, even though Home Depot may go up over time, if the market's going to come off 5%, chances are very good that Home Depot is going to come off 5%, not 5%, but it's certainly going to come off too. But if, let's say, you bought Home Depot and shorted Lowe's against it, well, now you've taken kind of the market risk away, because if the market did come off, you should make in Lowe's pretty much a fair amount to offset what you'd lose in Home Depot. And what you've really done is created what's called a pair trade, by which you're really picking the one that you think is going to outperform to go long, and the one that you think will underperform the other to go short. Now, could you theoretically lose on both sides? Yes, the one you went long could go down and the one you went short could go up, in which case you did a lousy job of analysis, because these two names did exactly opposite what you did. So yes, it is possible you could lose more than if you just, let's say, went long the Home Depot. But the advantage to doing a pair trade is reducing the risk overall, as well as taking the market timing away. And these are generally, they don't have to be long-term trades, but if you're doing it more based on fundamentals, then this is often the way the game is played, is that you hold these names over time, and ultimately the fundamentals take over. And if you're right with your analysis, or follow analysts on Wall Street who kind of have their overweights and underweights in their sectors, it is a way of reducing the risk of simply buying the name that you prefer, but you run the risk that your timing's bad on when you bought it. So that's pair trades in a nutshell. And tons and tons of hedge funds use this long short approach, and sometimes you'll hear the term as it's a long short hedge fund. And what they're doing is a deep dive into the fundamentals, and sometimes a quant picture and a technical picture overlaid, that look to pick the better of two similar type names. And this way, the portfolio manager has reduced risk around the market timing, and basically is just saying over time, the analysis we've done has said that company A should do better than company B, and therefore I can hedge some risk by buying A and shorting B. That's what pair trades are, and I'll tell you that it is generally a good way to reduce some risk, but still capture potential movement, regardless of which way the entire market moves, because all you need to do is have the one you went long do better than the one you went short. So let's say, even let's think about this in the crypto space. You could, in theory, buy Ethereum and short Bitcoin. They both obviously have been going up, but certainly in the last several months, if not the whole year, Ethereum's return, let's say year to date, has been greater than Bitcoin's. So it's not like you want to be short Bitcoin outright. This is just saying that I think Ethereum could outperform the performance of Bitcoin. And that's just an example in the crypto space. This is, in theory, done all the time in the foreign exchange space, because let's say if you're buying the euro, in theory, you're shorting the dollar. If you're playing the euro against the yen, which is called the euro yen, if you're long that, then you think the euro is going to outperform the yen. And again, it doesn't really matter if the whole currency goes up or down, the whole pair. It's just that one does better than the other. And again, this is a very, very commonly used type of strategy on the street to reduce the overall portfolio's risk, but still gives you the chance to make money. If they moved exactly in tandem, you wouldn't be able to make money because the one that you're long would make as much as the short lost you, in which case then your pair trade hasn't moved at all in its ratio, and you don't make money. But again, this is a way to reduce risk. And what we're going to do is, first we'll take a look at the four major indices that we're going to look at today: the Dow, the Nasdaq, the mid caps, and the small caps. And then we'll take a look at how they perform against each other, so that there's a couple of advantages here. One, you may know you could put them on as pair trades if you can identify what's the likely trend in this, and therefore you can reduce your overall market risk by being long one and short the other. It also gives you a way to look at playing different sectors, or cap parts of the market, or like the Dow 30 versus, let's say, the Russell 2000. You're looking at 30 big cap names versus 2,000 smaller cap names. So that's in theory a large versus small cap type trade. And let's take a look at some of these. We'll start with the four individual ones before we get into the actual pair trades. So let's switch over to our charts, and here's just a chart. Everything we look at will be weekly charts. This is a chart of the Dow Jones. So we made new all-time highs yesterday. Today's Tuesday, so we went up high and have pulled back. We're beneath last Friday's close, but this still continues to work its way higher. We kind of broke out of a sideways range here that lasted since July, 3-4 weeks ago, and we've been edging higher. Whereas the bulk of the stronger support now is kind of it happens to be near the TDST line, which is 33,740, and that's where we bottomed in the September sell-off. So those 3 weeks lows were right by the low from July. The low in July was the TDST line. It was the lowest low in the most recent 9 count up. In the setup, 13 and 9 we saw here did lead to a sideways pattern for almost 2 months before breaking out higher. Why do I say that's where the bulk of the important support is? It happens to be where this trend line is, which goes way back to just after the March lows of last year. So the May low is this solid dark maroon line. And if there was a big gap up last November, we take a trend line from there, they're all coming into kind of similar place to where those lows were. So that's where the important support is, as well as we go forward over the next few months, the top of the weekly cloud. So that zone, let's just call it 33 to 34,000 is the more important support at this point. Shorter term support is going to be from where the breakout came. So let's call it at about 35.5, somewhere around there in the Dow. So generally, look, we know we just keep pushing higher. Sooner or later, we had a pullback in September in the S&P terms. I know it was 5.5%. I'm not sure what it was in Dow terms, but again, really minor pullbacks along the way, and this thing just keeps going higher. But I would kind of focus down on here that should we have seen a pullback down to 33 to 34,000, that's really where you kind of want to see this thing hold if we get a pullback like that. Let's look at the QQQ. So this stopped, and again, why do I like to look at the cloud model? The cloud model has been really good at capturing the lows, and you notice that in a strong bull market, you often climb up this first line, which is called the conversion line. It's the fastest line in the cloud model. The second fastest line is this orange colored line called the baseline. And what I like to see is on pullbacks, does the baseline hold when we've taken out the conversion line? And we stayed above it last November. We went right to it earlier this year in March. We went to it again in May, and we went to it precisely in October. So this baseline is very important support. I actually give it more important support than, let's say, what the 50-week moving average is. And the fact that it is now held 4 times, 3 of them actually came and touched the level, that to me says that 358 and change is where you want to see this stay above right now. And the higher we go, the higher these lines will go to. So first support kind of comes here from the conversion line, secondary support at the baseline, and then the really important support is at the cloud itself. And that's a much deeper pullback. Don't know if we'll see it. The NASDAQ still has not broken out above the 399 level, which has been a long-term upside target for me, going back to the sell-off in the spring this year. So we're still there. We're right up against, let's just call it the 400 level. We'll see if this can push to new highs or not above where this propulsion full exhaustion point is. Now let's take a look at the MDY. Do I have it up here? Let's see. Here we go, MDY. Okay, so this has a recent MACD crossover bullish. We broke out to new highs last week. You do see that we're still up against some propulsion targets, but here's something that I kind of see as interesting. This solid red line here is the stop out level to the 13 signal, the upside exhaustion signal that we saw here. And this was a terrific upside exhaustion signal because it showed up in June, and this has been sideways. So until a week ago, this indicated change of trend. What was the trend? Well, the trend was higher, and this 13 said change in trend likely. And it certainly did, because we went sideways for 4 to 5 months. Now we started to break out higher, and we actually properly exceeded this level that we got a solid line. So just in quickly looking, I want to show you something here. Without comparing them against each other, look at the MDY that is traded above, properly traded above the stop out level from that 13 to, I think it was the Dow. Let me see if it was the Dow or maybe it was the Qs. Let's see. No, it was the Dow. No. Well, I'll get back to it in a second. Maybe it's the IDM, the IWM. All right, so MidCap looks solid here. Again, I just want to see it kind of break out above these little targets right where it's trading. If it does, look for this to expand higher. And it has properly exceeded the signal that said it's sideways. So it's essentially renewing a new uptrend. And of course, it's above its trend line. Now let's look at the Russell. This is the one I haven't seen. Notice that the Russell hasn't yet exceeded the stop out level on the 13. So even though you've got this, last week was kind of the breakout to new highs, to me, the MidCap is just looking at a pure outright basis without comparing them. In a few moments, we'll start comparing these to each other on a single chart. But the fact that the MDY is properly above its stop out level and the Russell 2000 is not, makes me say that MDY is probably better than small caps. So that if you're going to invest now, mid caps are a place to look versus looking at the Russell 2000. So that's one way also that you can think of it. You don't have to buy, let's say, MDY versus shorting IWM. But what it gives you is the ability to say, look what part of the market, what on a pure outright basis, what's got the better chart, the mid cap space or the small cap space? And right now it's the mid cap space because it's already exceeded the resistance it needs to. So that means that I would tend to focus more on mid cap names if I'm looking to buy individual names than I would into the small cap space. All right. Now, so that's the 4. That's the Dow, the Qs, the MDY, and the IWM. Now let's start looking at them as pair trades against each other to see if we can discern anything in the charts. So again, these are weekly charts. So what do we have here in the black? The black is the ratio of the Dow divided by, so here you can see in the upper left-hand corner, this is the Dow Jones Industrials divided by the QQQ. So this is saying that we're looking long-term here. Over the last couple of years, this chart clearly is faced downward. I've got negatively sloped 50 week, I've got negatively sloped 200 week, and it's pretty darn easy to see that this has mostly gone in a lower, especially in 2020, a very precipitous drop, meaning that the Dow underperformed the QQQ. So that, flip that around, it means that the QQQ outperformed the Dow, right? So the NASDAQ 100 tracking ETF did better than the Dow. And some of the names are similar, but obviously there's plenty of names that are not in the Dow that are in the Qs that have been flying. And therefore, if you were looking to kind of play the indexes, and it's still essentially telling you that the Dow is underperforming the Qs. So that if you're going to look at names, look more towards Q names. Now, again, there's some that overlap, but as indexes go, the QQQ is outperforming the Dow Jones. Or we can put it this way, the Dow Jones is underperforming the QQQ because this keeps heading lower. Let's look at now the Dow versus mid caps. So let's just do it right here. DJI divided by MDY. So this has been hugging in the 50-week moving average, can't get through it. So like same thing, the Dow is underperforming mid caps. And now we're still above, there's kind of a triple bottom down here. Let's blow this up a bit. And there's where we've got 3 lows from earlier this year. Looks like, we certainly might test it. If we exceed it, you probably get a whole nother leg that mid caps do better. So again, you had the big breakdown. When this was heading higher, that means the Dow was doing better than the mid caps. Since just about fourth quarter last year, mid caps did better than the Dow. Dow had a bounce mid-year and it's come back. And again, we're testing down here, breakthrough here, and we likely head lower. So right now it's not clear cut, but a breakdown here would say you want to be in mid caps, not the Dow. And of course, the Dow with only 30 names in it, 1 or 2 names can really impact this and change directions of what's going on. And let's look at the Dow versus small caps, the IWM. So interesting here, whereas versus mid caps, the Dow stalled against the 50-week. This got above, but it's broken down. But it's not nearly as close as the lows. So you can see that here the Dow is doing better against small caps than the Dow is doing against mid caps. You also have a new fresh sale here on the MACD. It's just crossed underneath the 0 line. So this would probably indicate that this can go lower too. But again, you start seeing the relationships here, and it gives you a decent clue about whether you want to trade these simply as pair trades, whether you want to, if you, let's say you have cash that you want to put to work, and you tend to be a passive investor in the sense that you buy these ETFs of equity indices. Well, after we go through all these, you'll have a pretty good sense of which ones you want to get your exposure in, because you can see instead of, let's say, just putting money, in large cap, you may be better off putting money in mid cap or small cap. And this, by looking at this, it gives you a much better feel on where to go in the market itself to put your investments. So this was what Dow versus IWM. So then next we would do QQQ versus midcap. different picture, totally different picture. Been, several months, almost 5-6 months of the Qs outperforming mid cap, but now we're starting to see some stall. And we can certainly, do some basic technical analysis here, at least for the time being. There's your downtrend line. You'd want to see this break above in order to think that Qs can keep outperforming the mid. Otherwise, this is going to pull back and get more into the center part here. We'll just have to see. You can see from MACD, it's unclear. Even these guys are sideways. So you want to see, the best signals from MACD is when you start seeing the spread between the two of them get wider and wider. That's when you have momentum in that direction. When they're like this, you really can't tell which is going to be the predominant one until you start getting a real spread. So right now, this is a tougher call, but we do know, at least for the time being, it looks like it's starting to, pull back against the downtrend that we drew from the highs that we saw. Now we look at QQQ versus IWM. We have a pretty darn similar look. Actually, this is well beneath that downtrend line. So this is actually weaker. Now there is a better uptrend line here that we're kind of just playing with. It seems to have broken, but it's, when you look at pair trades, these things tend to, you got to give a little more room before and breaks of trend lines. Again, there's not much to work with here. This is slightly negative, but it hasn't, the MACD hasn't pulled apart yet. So I'm not getting a real clear picture here. I'd say there's a slight bearish tone to it. You did do a weekly 9 up that we've stalled since. We are underneath, kind of, if you want to look at that as the breakdown point to this move here. But again, not a huge thing to look at in between. Let's look at mid cap versus small cap. A mishmash with the moving averages, so it's not telling you much. We do have a 13 for upside exhaustion here. We've pulled back from that. You do have a negative cross here. Another week or two of expanding gives you a clue that this can come off. And if you look at this kind of, I don't know, let's pick maybe here, that purple line is the breakdown point. We've come to it a couple times and failed. So here, this would suggest it's going lower, which is that mid cap could easily underperform small cap, looking at it purely on this point of view. The last one we're going to look at is growth versus value. And this chart to me is very telling. You had this support level that broke down. Do a double bottom, you came back above, you stalled at the all-time highs, you pull back, and then you've broken out. So this would say that growth, IVW, is outperforming IVE value. And so you'd probably want to stay more in the growth part than the value part of the market based on this. And you've got, a bullish crossover here in MACD too. So that's it for this week. That's a look at pair trades and how you can get a lot of help by looking at ratios between two similar types of, whether it's indexes or individual names, in order to put on reduced risk type of trades. I'm Rick Bensignor, and this has been In the Know Trader. Hope you like the show.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.